there is this idea in the market that alternative markets, private markets are somehow not correlated with public markets. I think it's not true. In a crisis, all markets, all asset classes, tend to exhibit a high correlation. The difference is that private markets are slow to adapt. I think the fact that creates this illusion of diversification. If everybody wants to get out, they all want to get out at the same time. There's not enough capacity available, there's not enough capital available, and it takes time.
Hi, Adam Gower here, founder of gowercrowd.com and host of this podcast and YouTube show, Real Estate Market Watch, current events through a real estate lens. My objective of this new series is to try and shed light on what's going on in the markets by speaking to some of the industry's foremost experts and knowledgeable participants. My guest today absolutely fits that bill. Jim Dowd is CEO of North Capital, and his career actually goes back as long as mine, believe it or not, to the early 80s. He and I spent time in Tokyo at the same time during the 90s. I'm fairly sure that we must have met, probably, even if we didn't meet professionally, but we always used to hang out. I think all of us, we expats, used to hang out in the same places in Tokyo. So I'm sure that we probably rubbed shoulders at some point during that time. But I've come to know Jim over the last few years, and he is an exceptionally knowledgeable player in the industry, as you will hear in our conversation today. If you've not already subscribe to my newsletter, please go to gowercrowd.com. There's a big subscribe button there. And in the newsletter, I'm providing detailed summaries and analysis of what my guests are talking about, including, of course, Jim, today. And I am also posting on LinkedIn. So if you've not connected with me on LinkedIn, please go ahead and do that as well and join the conversation there. It's actually a very interesting place to exchange ideas and to learn from each other. All right. So without further ado, let's meet Jim Dowd, CEO of North Capital, coming right up now. Jim, what a pleasure seeing you again. Thank you so much for joining me. Why don't we just kick off? Tell me, you have quite a storied background, so don't be shy. Tell me about your background and get to North Capital and what you're doing for who.
Sure. Well, first of all, thanks for having me, Adam. It's always a pleasure. And my background in securities markets is this is my 40th year. So, and it's almost to the point now where I've spent kind of an equal amount of time on the sell side and on the buy side. I'm currently the chief executive of the North Capital group of companies. We have a registered broker dealer, a technology company that supports our brokerage activity, and a registered investment advisor. And before starting North Capital in 2008, I was with Bear Stearns and started and ran our hedge fund platform that we used to make available individual hedge fund strategies to our brokerage network and the clients of the firm and the clients of our broader correspondent broking network. Prior to that, I worked as a portfolio manager for a number of years, as a buy-side portfolio manager running arbitrage strategies and derivatives, mostly in Asia, actually. And then, as you know, I also spent some time in Tokyo. I know you did as well, back in the 90s, running the derivatives and capital markets business for Bankers Trust. And I did that also in New York and London. It was involved in derivatives and trading. So that was all kind of sell side activity, but really, and started in 1985 with Samuel Montague, a British merchant bank, in the early days of the swap business. So pretty much have seen a lot of different sides of the market, but have kind of continuously been involved.
What is the mission of North Capital and who are your clients?
Yeah, our mission is to expand the access, improve liquidity, and improve transparency of private markets for our clients and for the market generally. Primarily, we serve issuers and professional intermediaries who are marketing and selling on behalf of issuers and running platforms on behalf of issuers. But really, our clients are both the issuers and investors because investors are really the kind of the renewable resource, if you will, that kind of drive the capital markets. So investors are ultimately need to be served by the issuers and the intermediaries who work with them. And so we try throughout our practice, whether or not we're working on the technology side or as a broker or providing advice to really keep the investor front and center.
And you work with real estate companies do as well, don't you? So in what capacities? To kind of describe that so that we
Yeah.
can contextualize some of this.
Yeah, so we really offer kind of the full a full range of services as a managing broker dealer for the real estate sponsors that we work with. Everything from investor sourcing, investor pre-qualification, accredited investor verification. We hold the licenses for the representatives that are professionally selling and raising capital for the fund sponsors. Sometimes it's through individual closed-end funds supporting a single project or a handful of projects. And now sometimes the real estate managers will run evergreen funds, and those funds will be used to tap into development capital as it's necessary. So we do all of that. We also are a custodian for private securities. So if someone wants to invest in a particular deal through an IRA or a Roth account, then we support that activity for private securities as well.
What kind of scale in terms of the funds? Just what size do you deal with?
Yeah, I would say it's a pretty broad range. I mean, we will work with relatively startup managers who might have 25 to $100 million of assets in their fund. Sometimes even smaller if we think that they can get to scale over a reasonable time frame. Our three largest managers are each multi-billion dollar managers that have very long and storied track records going back 30, 35 years. And those managers raise more like 250 to $300 million a year.
So this is what you call private securities, is that right? That's basically the general term. So what are you seeing, or what are you running into consistently regarding the role of private securities in general, and where are you seeing capital flowing at the moment?
Yeah, it's a great question. I mean, there's been a kind of a long-term secular trend towards private markets, I think for a number of reasons. One is that the cost of accessing public markets has continued to climb because of the regulatory overhead and cost of all of the associated expenses to bring a public offering to market. And the cost of doing private offerings has reduced over the years. I mean, it's one of the few areas of financial markets where the capacity has expanded, the interest has expanded, and costs have come down. And that's been good for issuers. It's also been good for investors because a lot of investment opportunities that traditionally might have only been available to investors at higher minimum investment levels have now, dropped to 10, 15, $20,000. Whereas, when I started in the business, it was 250, $500,000 to start. So that's made the market quite a bit more accessible. So there's kind of the secular trend that is public to private. And then I think there's a kind of an additional trend associated with that, which is that private markets generally are now starting to tap into the retail investor a lot more than 10, 15, 20 years ago, where the kind of the preferred stopping point was was institutions. At some level, some issuers almost looked down upon the retail investor, and now there's no shortage of top tier firms and sponsors that are really trying to specifically address the retail investment market, both retail direct and advisors.
Right. So, but now, being a broker-dealer, the 2012 Jobs Act doesn't really impact you because that was really what legalized general solicitation. But is that what you're talking about in terms of the expansion of this shift into private securities?
I mean, I think the shift was occurring even before those changes to Reg D, and kind of the relaxation of some of the requirements under Reg A plus, and then of course the creation of the Reg crowdfunding exemption. But
Mm.
even before any of those changes came into effect, there was increasing interest in private markets for a few reasons. I mean, one is as I say, just the fact that issuers were beginning to tap into private markets more than public markets. So investors go where they think the best deals are. And then secondly, I think that there was a recognition that you could access private deals at lower minimums and potentially actually establish something a diversified portfolio with private investments. And that really wasn't possible before the Jobs Act. I mean, there was just before general solicitation, it was very difficult to be able to run you know, at scale a fund that would be able to, uh, you know, make use of retail investor capital at levels that would make sense.
All right, so let's return to this. But for, what I'd like to talk about is deregulation. Now, you and I have been in this business for about the same amount of time, but different angles. I've always been in the real estate side of the business, sponsor side capital formation. And we both lived through the global financial crisis. In fact, you were at the very tip of the arrow. That's if that's the right term there at Bear Stearns. So after the global financial crisis, a lot of regulations that were put in place specifically in an attempt to avoid making the same mistakes that almost led to a systemic collapse of the financial system, not just domestically, but worldwide.
Sure.
Now, the current administration is looking at a lot of deregulation, particularly some of the aspects of Dodd-Frank and the Volcker rule, etc., and particularly with the dismantling of the CFPB. So, first, can you just describe what those rules were? And what is the deregulation that you're seeing? And by doing that, are we not setting ourselves up to make the same mistakes again that we learned to avoid in the GFC?
Yeah, I mean, of course, I wouldn't consider myself an expert on on the GFC or the causes of it. Despite I think of it more as being at ground zero rather than being at the tip of the arrow.
Yeah,
But
that was the
either
term used.
I
Yeah,
was
ground
I was
zero.
kind of inside the blast radius, if you will,
That's right.
being at Bear Stearns. But I think that I think that there were a number of lessons that came out of the GFC. I mean, one is that the industry was massively undercapitalized at the time. The banking industry, the securities industry, the risk capital that was held against assets that we came to know were actually very risky. And I think that's changed completely. I mean, the financial system is much better capitalized and able to absorb shocks than it was at that time. So that's kind of the first
Okay.
difference. I don't know how that plays into whether or not regulation or deregulation will potentially create some of the same misincentives that existed at the time. But clearly the industry in general is better capitalized and able to absorb problems than at that time. The second thing I would say is that the very best risk mitigation mechanism and an investor protection mechanism, in my opinion, is a properly structured market system. So one of the problems that I think existed prior to the GFC is there were a lot of crazy incentives that existed within financial institutions that were investing in some of these products that essentially encouraged institutions to take certain types of risk at excessive levels because of the way that the securities were structured. The idea that you could take, you know, a number of below investment grade assets, package them together, and then come out with an asset that's two-thirds investment grade and one-third, below investment grade is sort of manufacturing credit quality. And what we found out, as a result of the dislocations that occurred is that, ultimately these were just bundled below investment grade assets, and you can't sort of package up a lot of poor quality assets and expect to end up with a partially good asset at the same if there's a high correlation between all those assets. So I think the other aspect of kind of what's changed since the GFC is that most of the credit risk taking in that's occurring and that has occurred is not taking place in the banking system. I mean, you have a fundamental disconnect, and Mark Rowan at Apollo has talked about this very eloquently. I would encourage anybody who's interested in kind of understanding some of the dynamics of the private credit market, including with real estate, to listen to some of his talks. But he talks about a system that existed before where you're essentially taking depositors' capital, so capital that needs to be government guaranteed, needs to be backed full faith and credit, and then using it to invest in illiquid loans and other assets that could go south, could go sideways in a crisis situation. And that's fundamentally a problem that is, not in the interest of the government backstop for those institutions. And what's kind of happened since that time is that all of that credit risk taking has kind of migrated into private markets backed by mostly by equity, but then to a lesser extent with some of the same collateral structures and that were existing before. But I think that's a change for the better. As far as the individual regulatory changes around Dodd-Frank and CFPB and that, I mean, I have a perspective that a lot of the regulation kind of went too far in the direction of more regulation, but I'm not, I think we'll find a balance, and it will just take time for the market to kind of readjust.
Right. So the risk that was inherent in the system that was closed out with the regulations after the GFC, am I correct in understanding that what you're saying is that that has shifted to the private securities industry? So the risk is still there. It's just shifted away from too big to fail institutions.
Yeah, I think that's right. I think that for sure a lot of the risk is shifted away from the banks and the too big to fail institutions. I think additionally, I don't think that what cured or prevented a repeat of the GFC was all this great regulation that came in. Like I think that it's a little bit like closing the barn door after the horses have run out. I mean, yes, there are definitely, requirements for more capital, requirements for greater transparency, requirement for real-time collateral on derivative products, for instance. Those were all changes that, are intact and, will continue to go forward. I'm not sure that the folks who created CFPB, who have this narrative that the cause of the financial crisis was predatory lending, and that the banks manufactured the crisis to take money from the little guy. I think that's a false narrative. And so some of the solutions that came out of that narrative, I don't think really contributed to safety and soundness of our markets.
Yeah, very interesting. All right, I'm going to ask you a totally and unapologetically impossible question to answer.
Sure.
So, all these regulations were put in place in hindsight,
Yes.
right? So no one realized what was going on until it was too late. Then there was the crash, and then these backstops or these guardrails were put in place.
Hmm?
Here's my impossible question, or impossible question. Question is impossible to answer. What blind spots do we have today, do you think?
That's a good question. I certainly wouldn't claim to know what all of them are, otherwise they wouldn't be blind spots.
That's
But
exactly the point. We know
but
what we know. What was it that, what was his name? Cheney, I think. Wasn't it he that said, it wasn't Cheney, he said something like, we know what we know. We know what we don't know. It's what we don't know that we don't know that is the,
it's
is
gonna is gonna bite us. Yeah, no,
right.
exactly. I mean, I think there are a couple of areas that are that actually we deal with all the time that I worry about,
Mm,
and I especially worry about it in light of kind of what I described before about the migration of capital. One is there is this idea in the market that, and it's been an idea that's been promoted heavily by a lot of fund sponsors and managers that alternative markets, private markets are somehow not correlated with public markets. And so the sales pitch goes, you've got your stocks, you've got your bonds. Now you can allocate to alternative investments and you can get diversification.
mm,
And I think that the real story there is somewhat more complex and I mean, at some level, it's less complex, and in some levels, it's more complex. I think it's less complex in that I think it's not true. I think that generally, in a crisis, all markets, all asset classes, tend to exhibit a high correlation if they're risk assets. So people talk about risk on, risk off. I mean, you can have risk on and risk off in private markets, just like in public markets. The difference is that private markets are slow to adapt. So I think the fact that private markets are slow to adapt in terms of valuations, in terms of pricing, in terms of a lot of different aspects, creates this illusion of diversification. And if you kind of run the same types of correlation analysis between public and private assets over a longer period of time, you find that in fact they're much more heavily correlated than you might have thought. Um, where that creates, so that I think is a blind spot that people just may have risk in their portfolio that they're not aware of. I think where that becomes particularly acute is that, and this kind of goes back to what I said a minute ago, and that I didn't really explain, that the best one of the best ways to protect investors is through the market system. And the problem with alternatives is that you don't have a working market system. You can get into these investments very easily. It's not so easy to get out. It's kind of like the metaphor of three fat guys running for a thin door. It's like if everybody wants to get out, they all want to get out at the same time. And there's not enough capacity available, there's not enough capital available, and it takes time to restructure these portfolios. So that, I think the market was reminded of that with the B REIT liquidity gates that happened a couple of years ago. But really, it's something that we talk about, in doing every investor review, is the fact that a lot of these private securities have no liquidity or very limited liquidity, and that's also something that I would like to see changed. I think there are some institutional and regulatory reasons why we don't have liquidity, but there's no reason that we shouldn't have liquidity in private markets as well.
right. So when I think about this concept, I think of sponsors who are raising, 10, $20 million of equity for a $50 million acquisition. I mean, pick whatever number you want.
Yep.
And their limited partners buy into these private securities and they're locked in. I mean, you're
Yeah.
locked in. So in what way could that, and this is a little bit off topic. I want to get
Yeah.
to some other stuff, but in what way can this illiquidity issue, which I think is what you're talking about, how can
hmm
that be resolved? Is this something that you guys are working on? It is, isn't it?
Yeah, we've been working on it through our alternative trading system, or ATS, that we set up in 2020, and has been gradually growing in terms of number of issues and the scope of markets and the activity in the market, to be able to provide a secondary marketplace to be able to trade in these private securities, or these exempt securities.
Mhm.
And in there's I wouldn't say that our marketplace sort of creates you know sort of perfect liquidity. It's not like trading a stock on the New York Stock Exchange or even on OTC markets and at their QX kind of level of exchange. But it does create the possibility of liquidity, and I do think that there is increasingly a recognition that the market as a whole would benefit from higher levels of liquidity. Because if you can imagine, it might not work for a $20 million offering, but imagine a $100 million offering, which you know 100 million and up still covers a lot of the volume in the market. Imagine a scenario where, say, after a 6 month period, those shares could be listed on an ATS at a relatively low cost. And then if you needed to liquidate because of estate planning, because of transitions, because you need the money, you might not get $1 bid ask spread, but you would at least have the possibility of being able to exit the position. And then, of course, people who are interested in buying assets on a discounted basis would have an incentive to come in and potentially bid. And we've seen that happen with some of the offerings that we've done. So we've been involved a little bit in real estate, not as much as in some of the collectibles markets and others, but we've got two very large real estate groups that are in the process of doing the final work to integrate and list their securities on our ATS. And I think it's gonna be pretty exciting when it happens because we've got some now, but there's a lot more in the pipeline, and I think it'll be a good thing for the market.
Yeah, there is. Correct me if I'm wrong. You're somehow involved with Masterworks, aren't you? Is that? Yeah,
We are, yeah. So we list their securities, and that's collectible art. So that's a different asset class altogether, but it's the
yeah.
same principle. It's like people can invest in the primary offering, and then they can seek liquidity on the secondary side. And we don't have market makers of that. You have to find a willing buyer and a willing seller, but that's ultimately what markets are about. I mean, the market makers exist to kind of grease the wheels, if you will, and facilitate that crossing. But ultimately, markets are about having willing buyers and willing sellers. And I think that the transparency that you get from that, because price discovery, price is the best indication of what people think about the risk of a particular investment is. So by having that price transparency and that access and that liquidity, it really eliminates potentially a lot of the risk that people don't know exactly where the valuation should be, or that the market gets caught one way around, which happened in the financial crisis, et cetera.
Yeah, so you've talked about migration of capital, and this is kind of related, but let me move to a different form of, or a different perspective on migration of capital under the banner of America as a brand in global finance. We enjoy this idea of exorbitant privilege where we can borrow as much as we want at low interest rates because of the confidence that overseas investors and domestic investors have in the, when I use this term, it's not quite right, but the full faith and credit
Hmm.
of the US government and the systems and the institutions that we have here in our governance, etc. So, but what are you seeing in terms of changes brought about by the current administration? And I don't want to get political at all, ever, but through the lens of real estate primarily, what is the impact uh, on capital flows of the, I want to call it preemptively, obvious degradation uh, in our reputation as a the dollar as the reserve currency.
Hmm. Yeah, I mean, of course, I don't know. I mean, I think that what we've observed so far is that the market does not like uncertainty, and so the uncertainty in the economy and in financial markets that was created by Liberation Day and then sort of the subsequent discussions that different administration spokesmen would have in the media, I think created a lot of uncertainty, and so it had a little bit of a chilling effect on the markets in terms of just deal activity. People not knowing, do I want to bring this deal right now if it's kind of a marginal project? I mean, maybe the risk on the project hasn't material changed, the idiosyncratic risk, but the market structural risk has changed, and people may decide that they don't want to do the big deal right now while there is this uncertainty. In terms of the brand specifically, and I know that's kind of what you asked about, I think that's number one, I think the effects on that will probably take some time to sort out what the impact has been. And then I think in general, and maybe this is a little bit Pollyanna-ish, but I feel like that the market has a very short memory. And so I think if we had sort of this, horrible meltdown and, is to sort of was the way it was described in kind of March and the first part of April. And then we've had a fairly dramatic recovery in the second part of April. And if you really look at sort of the round trip of public markets between, say the middle of last year and to date, we've still done quite well, and most of the losses that occurred in March and April, we've kind of retraced. Now, I think if we get more uncertainty, and if the kind of the threats and the potential implications from some of our policies cause investors to make, long-term permanent reallocations of capital away from the US, then for sure our capital markets will suffer. I mean, less capital, means that sponsors, do less activity means slower economy, and there's kind of a ripple effect through the system. But I heard someone on the news the other day sort of say that the sort of the era of kind of hyper exceptionalism maybe is gone, and now it's just exceptionalism. So I don't know what that means and how you quantify that, but I would say that a lot of these, we're really talking about 2 months of pretty intense volatility. I don't think that's going to extend out for 2 years.
Okay, but how long for? 4 years? No, I'm kidding. All right, so as always, you're very modest in expressing your opinion. So let me shift to something perhaps you can anchor on a little bit more, and that is the perspective that your clients have, investor sentiment amid these economic shifts. What trends are you seeing among your commercial real estate clients in response to these economic uncertainties?
Yeah, I mean, well, I think the first thing is that investing is generally either, very macro or very micro or both. And what I mean by that is that 20 years ago, most of the active investment decisions that individual investors would make revolved around, picking stocks or having their broker pick stocks or picking, actively managed mutual fund managers who they thought would outperform the market. And what's happened over the past 20 years is that the traditionally active managed mutual fund business has declined, and people hold most of their liquid assets in ETFs, and in sort of passive ETFs, and in more passive, broadly diversified strategies, the S&P 500, or Russell 3000 is, on the equity side, and the Barclays aggregate on the fixed income side. But there's still active investing occurring, and I think what's happened is that active management has migrated from publicly managed funds and, stock picking brokers to private markets, where you really do have more idiosyncratic risk and idiosyncratic opportunity with individual projects and individual managers. So one of the themes that we've been pursuing and we've been seeing with our top managers is that a lot of the distribution is local. I mean, we have managers I mentioned who raise $250 million a year, and a lot of times it comes from, advisors and investors that are within 100 miles of their headquarters. It's not like they're casting this wide net nationwide to find the proverbial retired dentist in Boca Raton, that's investing in these projects. It could be the local businessman down the road or woman down the road that's allocating their capital to projects that are in their community. And so I think that is a perfect example of how the market can be both very macro in the sense of people holding their liquid investments in, broadly diversified low cost funds, but then making fairly significant private allocations sort of in their local markets. And I think that's a trend that has not really been disrupted by market events. I mean, the people may be more discriminating, and certainly the I would say the move in interest rates from sort of zero to 4.5% in the short end, and up above 4.5, up above 4% in the long end, has had a larger, more significant impact on the real estate market than anything that's happened in the past couple of months. I think the past couple of months has been more about this kind of climate of uncertainty causing people to kind of slow down whatever they're doing, whether it's a sponsor slowing down on their pace of activity or an investor, maybe dialing back where they might want to allocate their capital.
Are you seeing any particular or emerging asset classes or markets that are gaining attention due to these shifts?
Besides crypto?
Well, it's funny because, b before we started talking, we went through a few topics, right? And I
Yeah,
did say, until I showed you my little pit movie over here, I did say there was one thing I wasn't going to ask you about
which is
because
crypto. Yeah.
various reasons. One, I don't know anything at all about it, so I'll be completely lost. But go ahead, lean into that a little bit, understanding that I have zero knowledge about that. I'm not shy to admit that, but I know it's a big deal for you.
Yeah, I mean, I would say we don't do anything in cryptocurrency, Bitcoin, ETH, Solana, any of the sort of the so-called cryptocurrencies. Where we've spent time and made investments is in the area of tokenization of assets. And really I would say that is supportive of our general business model supporting private and other exempt assets. And the idea being that if you really want to develop scalable, transparent, liquid markets, make them accessible to a broad range of investors and do it at low price points, crypto blockchain related technology seems like one of the better ways that we've seen to be able to do that. It's not the only way. I mean, there are definitely other ways that it could be done, but it seems like a way that some of those technical changes could be scaled at a relatively low cost. And of course, where that the reason why that hasn't really developed in the past 8 years since we started looking at this in 2017 is because of a disconnect with government's perspective on how those markets ought to be regulated, and obviously that's changing. So the first changes that were put in place were related to cryptocurrency. I think we'll see stablecoin legislation, and then I think market structure of other digital assets, including digital asset securities and tokenized securities that'll probably come last, but we're planning on that. But I think, in terms of where investors are looking at it, investors are always looking at where can they get the best return and mitigate or reduce risk in their portfolio. And crypto, certainly has historically delivered some of those return characteristics, and I think it's caused it came along at the right time and gained a following, and then it drove the prices up, and so now you've got trailing returns that look attractive, and as you know, nothing begets more capital like good trailing returns. So my hope is
That's
that
right.
that doesn't harm a lot of investors, and certainly like I say, we're not allocating in our advisory practice, we're not allocating to crypto on behalf of our clients, but most of our clients have some engagement or investment with crypto.
In what way? How do they engage and invest in crypto uh, in when they're in the real estate industry? Again, dumb question from somebody who really doesn't know what this is about.
No, I don't think it's not a dumb question at all. I mean, I think in some cases it's just looking at Bitcoin as a store of value potentially. So, and not for your entire treasury or anything like that, but I think if for people who are
Mm,
looking for a diversifier, we've got a lot of questions about how can I diversify my exposure to the U.S. dollar. So this
that's
narrative that if exceptionalism is over and if the U.S. is kind of moving in a direction where we'll no longer be the reserve currency, what's the replacement? I mean, are you going to buy, you know, euros? Are you going to buy Swiss francs? Maybe you do a little bit of both. Maybe you do some Japanese yen. Maybe you do some crypto. So that's, I think that, and it's not real estate specific. I think that's just investors generally are looking for, um, safe havens and perceived safe havens. I think Bitcoin has a hard time, given the volatility. I think it doesn't hit all of the requirements for that. But I understand why some investors want to have an allocation.
Mm. All right, so it is a topic that, as you can tell, I really don't know anything at all about. So thank you for that high-level overview. I just noticed the time, and actually can't believe how fast it's gone since we started. So I have three sign-off questions, rapid
Okay.
rapid fire questions. You can take as long as you like to answer them. So actually, what are the two or three, again, thinking about commercial real estate, what are the two or three market signals that you personally watch that give you early warning of any shifts in the industry? Yeah.
So the number one would be the yield on the 10-year note and
Mm.
substantial changes. Because I think if we see a significant move up in yields or a significant move down in yields, it blows up all of the real estate models. And we saw it when interest rates started to rise and people were not adjusting their cap rates quickly enough. And a 6% cap rate in a 2% 10-year note environment is fundamentally different than a 6% cap rate in a 4.5% 10-year note environment. So that's I would say the first thing. The second thing I would say is to the extent that overall flows in public markets start to decline, like is there sort of a flight to safety or a flight from risk that may not immediately impact private markets, but there will be a correlation to that, and it might take a couple of quarters to kind of percolate through. But there is a wealth effect with people's portfolios. So those would be the two that I would think of. I can't think of a third right now, but those would be the two that would be the immediate signals for me.
Okay. Second question. If you were advising a commercial real estate sponsor or investor, so let's say retail investor sitting on cash today, what would you tell them to be doing over the next? My question says 90 days, but 3 months to 12 months, over the next 12 months.
Yeah, that I mean, for the investor side, I actually my son texted me this morning and said, I've got some money in my Roth, Dad, what should I do? And I said, well, the best time to invest was 2 weeks ago when the market was lower, and the second best time is as soon as you feel comfortable doing it, probably today. And because we don't know what the market's going to do in 3 or 6 months time or a year's time. And I'd be pretending if I thought I had any better idea than anybody else. I think it's, over a short-term period, nobody knows what the market is going to do. You can think but the reality is that a lot of things can happen over a 6 or 12 month period. The one thing I'm pretty confident of, very confident of, is over a longer term period, and the longer the term, the more confident I am. Market risk markets will generally be higher. So whether that's real estate, equity markets, risk assets are called risk assets because they are more volatile and more risky, but they also tend to have longer term outperformance, and risk and return are highly correlated. So I think if you're investing over 3 month, 6 month, 12-month period, keep your money in short-term treasuries or a money market fund. Wait for an opportunity where you feel personally more confident. But if you're investing for a 10, 20, 30-year period, then pick a time horizon over which you want to allocate your capital. 3 to 12 months is a good time, and then just do it systematically, because an averaging in type approach is going to be a smarter approach than trying to pick the tops or pick the bottoms.
Okay, you just preempted question two, part two, which was when you talk about long term, what actually are you talking about? So you're talking about 10 years and above, right? I mean, this is
Yeah.
reality. You look at Warren Buffett retiring, I don't know, stepping down anyway,
Yeah.
after 60 years. I mean, he's got to be the ultimate long term player, this guy.
100%. And he had such has I mean people are kind of talking about him in the past tense, which is kind of sad because he's I think very much alive, and very much running the show there.
Mm.
um he has an incredible perspective, and I think he's recognized this in himself in making statements that he's not bothered by market volatility, market disruptions. And I think a lot of us would like to be more like Warren and in that respect. I mean, I get nervous when there's market volatility, and I've been doing this for 40 years. I've seen a lot of market ups and downs. I've managed large portfolios for institutions and for clients, and I take the calls from our advisory clients when they're worried. And I understand the logic, but at an emotional level, if the market's fallen out of bed, it's hard to kind of keep your rational, your rational head together. It's kind of like when your child gets hurt. There's the rational you about what should I do and stay calm, and then there's the emotional side, which is trying to keep your act together. So the markets are a little bit like that as well.
Yeah, I read an article yesterday. Actually, I spoke to Lisa Pendergast at Crefsey.
Okay.
She wrote an article. It wasn't Biznow. I forget exactly what it was, a Commercial Observer or something. I forget. But the headline was keep panicking and something
And carry on.
and keep panicking and carry on. Yeah, it was hilarious.
Yeah.
All
No,
right.
I'm always reminded of that scene in Story where where the guy says, "Now is the dinosaur says it's a perfectly good time to panic."
That's right. Well, you weren't brought up in England, but there was this great show when I was growing up called Dad's Army. And one of the
Okay.
characters in Dad's Army would panic. He'd love to say, "Don't panic, don't panic, don't panic." And it was like this fabulous, like it was one of his lines.
Right.
Okay. So, and actually, my question about what do you suggest somebody holding cash, you also answered. If you think about it over a 10-year period, but spread it out, go to something utterly
Yeah.
secure now and roll it out. That's exactly my perspective right now. We just don't know. So better to, especially if you're in a retirement account that's tax shielded. You're
Yeah.
getting 4.5%. I know you actually, I saw something 4.3%, but basically you're getting, mid fours. And if it's through retirement accounts, it's tax free basically, or tax
Yeah.
deferred, or whatever. Um, that's your zero risk baseline, right?
hmm
And how can you go wrong if you're just sitting on that for the time being? Okay, last question. What political or market developments are you tracking that you anticipate could give you pause to rethink your assumptions today about where the market's going?
Well, the most obvious one is a some sort of adverse geopolitical development. That's got to be high on everybody's list. We all know about the conflict in the Middle East, conflict in with Russia and Ukraine. I don't know that conflict between India and Pakistan was on anybody's bingo card, right? And
Right.
that now is potentially one of the most emerging dangerous areas of the world. So I think there are a lot of potential developments on the geopolitical front that could certainly impact sentiment, cause flight to quality wherever quality is perceived to be now. And so that's got to be sort of top of mind. Again, if you're thinking long term, I don't I think that the most important consideration is make sure you don't have more risk than you can absorb from a drawdown standpoint. So if you have a 20 or a 30 or even a 40% drawdown in your portfolio, and it's going to cause you to become physically ill, then you probably have too much risk in your portfolio. You probably need to have less risk in your portfolio, be willing to accept less return, but, be willing to have fewer health ailments and live longer. But so the political risk is one thing. I think making sure that your portfolio is right sized is kind of a corollary to that to be able to absorb whatever the market has to throw. I think the other potential risk is a very significant negative surprise on the inflation front. I think the market generally believes now that inflation has more or less been wrung out of the system. Um, the fact that we're talking mostly about how many Fed cuts and not about potential Fed hikes in the event of any sort of an adverse development, um, I think is a sort of indicates where the market is positioned. Obviously, energy prices are substantially lower in the past 6 months, which is favorable for inflation, but there are a lot of mitigating factors, including unintended consequences of tariffs, unintended consequences of changing trade flows, et cetera. And if I'm not expecting a pop in inflation, but if we did get a 4 or 5% print, something that really jolted the market, then I think that would cause a lot of people to rethink their investment strategies.
Jim Dowd, CEO at North Capital. What a pleasure. Thanks so much for joining me today.
Thank you so much, Adam. I appreciate it.
All right, that was Jim Dowd of North Capital. Jim, thank you so very much for joining me. It's always a pleasure to see you. I'm glad that we did talk about crypto a little bit, even though it is a field in which I really know very little. I am just a bear of very little brain, as Winnie the Pooh would say. So I try and keep my focus entirely on commercial real estate development and sponsorship and investing. That's about the extent of my abilities. But it was really interesting to hear you talk about crypto. So maybe we'll revisit that in the coming months. And it would be good also to just see where we are in a few months and reflect on our conversation today and figure out how the world actually is evolving and changing. And thank you too, dear listeners and viewers. I'm really grateful that you join us during these podcasts and that you are with us here today. If you've not already done so, please go ahead and subscribe to my newsletter at gowcrowd.com. It's totally free. You can always unsubscribe, and I will be publishing editions as soon as these podcasts are produced. Okay, so not the usual regular weekly publication, but as the podcasts are recorded and produced. Okay, that's it from me today. Until next time, this is Adam Gower signing off.